Hi Emma, I hope you're doing well and thank you for joining me today to discuss the latest events that are shifting the energy market. It's certainly been an eventful start to 2026 and it's showing no signs of slowing down. So on that note, I think it's pertinent that we start with the biggest topic to date, which of course is geopolitics. Since we've last spoke, there has been a significant shift within the LNG market, notably down to the loss of supply with Qatar and the UAE. Given the fact the forecast was quite bullish for that region at the start of the year, given what has transpired now, what's the consensus with the outlook?
Geopolitics has certainly been the main driver of prices this month. So the Strait of Hormuz has been essentially closed to commercial shipping since the beginning of March when the conflict began. And that is the shipping channel for essentially 20% of the world's LNG. So the global LNG market has essentially been down by 20% for the last month. So one key development this month has been the attacks against energy infrastructure, and most notably the Iranian attack against Qatar's Ras Laffan LNG export facility. The permanent damage that's been done to that facility means that for up to the next 5 years, Qatar's LNG capacity in terms of what they can export is going to be reduced by about 17%. So, and overall, that's about 3 to 4% of global LNG supply.
So a question we've been getting a lot from our customers is because how much we get from that region is minimal, why is it impacting our prices so much?
It's actually 10% of Qatar's LNG exports that get exported to Europe. The majority of it actually goes to the Asian market. So with Qatar halting their exports, it means that Asia aren't able to import from Qatar anymore, and therefore competition for LNG from other sources, so for the US, for example, becomes much more elevated.
So it's quite evident this is going to have a knock-on impact to commodity prices. Is it fair to say then that we should buckle up and expect some significant volatility ahead, or has the market already priced this bad news in?
So prices have increased significantly, as you'd imagine, over the last month. So the gas market has increased by more than 100% since the conflict began, and the power market has increased by more than 50%. And if you can cast your mind back to June last year when we had the 12-day war where Israel launched their attacks against the Iranian nuclear facilities, we did see an increase in prices then as well, but only by about 11%. So the impact this time has been much greater.
Okay, so if I were to take an optimistic view, a glass half full view, and the conflict ended tomorrow and the strait was reopened, how long would it take to repair the damage that has already been caused? And I guess a further question would be, should we expect a permanent change?
It can actually take a number of weeks for them to become fully operational again. So as an example, if the production from Qatar was offline for a total of 3 months this year, the production of Qatar throughout the entire year would actually be 35% lower annually, and globally that equates to about a 7% decrease in terms of the amount of LNG that's available on the market.
So clearly quite a significant impact to the LNG market. Given this could have a knock-on effect for some time, are there any alternative sources that can help to bridge the deficit?
So we were actually expecting an increase in the amount of LNG available on the global market this year of about 7%, but given the reduction of LNG available because of the conflict in Iran, it's likely we're actually going to have less LNG this year than last.
Okay, so this may sound like a silly question, but based on the numbers you've just quoted, wouldn't that put us at break even?
Yeah, like you say, that would make sense. The 7% reduction as a result of the conflict is an estimation, but also part of the 7% increase that we were expecting this year was coming from a 2% increase in Qatari production as part of their North Field East expansion project, and that has been pushed back to 2027 at the very earliest now.
Okay, so one thing I have noted is the recent surge in oil prices. Given how closely that can correlate to gas prices, have we already seen an impact with pricing, or should we expect to see further impact, or has there been no impact?
Yeah, so the correlation between oil and gas prices has weakened over recent years, but as you say, they're still very much driven by the same drivers. So we have seen really high oil prices up to sort of $120 per barrel.
Outside of the obvious and eventful driver that is geopolitics, has there been anything else that is quietly moving the needle? And by that, storage levels, any changes there, or anything to do with demand side that we should be aware of?
Yeah, so the conflict in the Middle East has very clearly been the main driver this month, but it has had a direct impact on some of the fundamentals. You quite rightly mentioned there European gas storage. So we're currently about 28.5% full in terms of Europe as a whole, and the obligatory target to reach by the end of the year is 90%. And the gap there wasn't a huge concern for markets prior to the conflict, because the surplus of LNG that we've spoken about was expected to be there to inject into storage. So now that we've lost that 20% of Qatari LNG from the market and therefore lost the surplus of LNG that we're expecting, there are now concerns about how we're going to fill storage over the summer months. One thing that has been implemented this month is the EU have reduced that target from the 90% to 80%, but the fill rate that would be required from current levels to still hit that 80% by the end of the year would be the fastest fill rate that we've seen since 2022.
So we've covered some pretty heavy ground today, which seems to be quite common with these catch-ups, understandably so. Moving away, from what's happening in the geopolitical landscape to something maybe a bit more optimistic. So is there anything lighter on the horizon, a silver lining that maybe the market is currently overlooking?
I'm not sure about silver lining or overlooking, and certainly not a particular driver of prices at the moment with the volatility that we're seeing. But the weather forecast for the next few months does look relatively good. So in terms of wind generation and precipitation, we're sort of expecting sort of average generation, but temperatures do actually have a bit of a bias towards the warmer side over the next few months.
We are entering hurricane season. Because we are currently so heavily reliant on Gulf Coast LNG, will that also have an impact?
The Atlantic hurricane season runs from June until November. And so you're right, we are really fastly approaching that. But forecasts are showing that we're likely to transition into an El Nino phase this summer. And that's a climate pattern that is essentially warming sea surface temperatures in central and eastern Pacific tropical oceans. So what that means is a likelihood for a weaker hurricane season this year.
And I assume even with the hurricane season happening, albeit it may be weaker, it could still do significant damage to some of the cargo coming out of the Gulf Coast.
Yes, if there are hurricanes, specifically in the Mexican Gulf, then yes, it can cause damage to the export facilities, but equally, any sort of hurricanes or particularly windy conditions can disrupt shipping as well.
So potentially then there could be further price volatility when it comes to the energy market, but in the short term and looking into the month of April, what are the key things that energy consumers should be keeping an eye on?
Yeah, so geopolitics is more than likely to be the main driver again throughout the next month. Over the last few days, we have seen prices fall moderately, and that's off the back of speculation that peace talks have actually started. However, if the conflict does continue to escalate, it's likely prices could push higher, and we're more than likely again to see elevated volatility throughout the next month.
Emma, finally, thank you for joining me once again today. As always, the insight you share will prove invaluable when it comes to conversations with our business customers. So thank you once again, and I look forward to catching up with you next month, as I always say, in hopefully less turbulent times. Fingers crossed.